Hello, Dr. Washington. My name is Ross Thompson. I'm a graduating senior finance major from Houston, Texas, and I'm here to present my academic journal report on individual investor activity and performance. I initially chose this article because the title, one, it stuck out to me. I have a personal interest in investing in the stock market and just other asset classes. And with my career after graduation, going into private wealth, I just wanted to learn more about the correlation of investor activity and how that can help their performance. So I was very interested to see what this article talked about. So here's just a background of the report. It was written by Magnus Dahlquist, Jose Vincent Martinez, and Paul Soderlund. This report is the authors examining the daily activity of and performance of individual investors from Sweden's premium pension system. An analysis shows that active investors typically outperform inactive investors. Contribution plans are becoming the main source of retirement income. The portability and flexibility of these pension systems are the main reasons that driving more investors to them. And most participants are not actively engaged with their portfolio and do not change allocations with market conditions. So this study was created to investigate the relationship between investors' activity and the portfolio performance in a modern contribution plan. You can see they use a detailed sample size of 6 million pension savers, and they brought that down to 100,000 participants that they wanted to analyze. This data allows them to track portfolios over a 10-year period and look at the daily, weekly, and monthly changes that these investors made. Inactive investors, which account for 93.5% of this sample size, they earned an average returns of 3.82% per year. Mildly active investors, which are investors in between the decile levels of 1 to 9%, which account for 5.8% of the sample size. They average returns of 6.82% per year. And highly active investors, which are in the highest decile level and only account for 0.6% of this sample size, they earn average returns of 12.57% a year. A performance decomposition analysis reveals that better performance comes from investors successfully timing funds and asset classes. So here is just the hypothesis of this article and what they're researching. And that hypothesis is that active investors in pension funds perform better than inactive ones. I believe that's a fairly simple one, but it gets straight to the point. And here's how they're going to approach this theory. They're going to do more precise measurements on smart money effects. They will use daily data that they can measure the performance of old funds from the movement that the change that takes place. And then the second way is that they'll provide evidence about the range of investor intelligence. Most investors look smart when the performance funds is considered. Only a fraction of those investors look smart when you consider the holding periods that they're having within those investments. Here with pension plan management, pension portfolios are either managed by either the individual investor or a financial advisor. Individual investors, which are called non-coordinated investors a lot in this article, they are broken up between either active or inactive investors. Active investors, they make changes to the portfolio during the investment period, and inactive investors, they did not make any changes towards their portfolio during the investment period. And then the other type of investor that we saw in this was one that had help from a financial advisor. And these are also called coordinated investors as well. These people who want to actively manage their portfolios, they can hire the assistants just to get better information on market data and get insight from a professional. We also saw some mass market financial advisors. They offered more of a generalized service that is meant for a group of large investors versus just a financial advisor focusing on one client. They identified the people in the study who were using these mass market financial advisors by seeing which group of trades, like 1,000 people made the exact same trades at the same time. So they just were able to identify they were using a mass market financial advisor. And that was about 8,115 of the investors in this sample size. So The system that we're mainly going to be analyzing in this report is the premium pension system in Sweden. The public the public pension plan in Sweden has two components, and the contribution rate of the overall system is about 18.5%. So it's broken up between the notional defined contribution plan. About 16% of the contribution plan is allocated here, and this is more financed on a pay-as-you-go basis. And then the next way, which we'll be analyzing a lot more, which is the premium pension system, and will be referred to as the PPS a lot throughout this presentation. That is only 2.5% of the contribution is allocated towards here. It functions like a 401k. Essentially, it functions like a 401k. By 2010, the system had 6 million individual investors with more than $40.5 billion under management. And the investment options are a subsample of mutual funds, where in 2000 there were 456 mutual funds, and in 2010 at the end of this report there were about 778 mutual funds. Here on this slide, I just wanted to look and analyze the funds that are offered in the Swedish premium pension system. This table presents a summary of the funds that are offered in the system. You can see how it's broken down between equities, fixed income, and just different default asset classes as well. And then it's broken down even further by the emerging markets or the type of geographic location. And also, investors are allowed to choose up to 5 funds at any point and change their allocations within their funds on a daily basis at no additional cost. So the data of this pension system that they collected throughout this article, it was, as I said, it was out of 6 million individual investors that they were able to gather data from, and they narrowed that down to a sample size of 100,000 investors, just to help with the numbers. 70,755 individuals were in the system at the launch and stayed up until the end when the report concludes in 2010. And then for each investor, they analyze the initial fund choices and all their fund choices on a daily basis. And they also take into consideration the data on their age, gender, and income as well. They consider returns net of fund management and admin fees and expenses to reflect the actual investor experience that you'll truly be able to see. Now moving on to this slide, this table breaks down the investor activity in population and sample size. This table also shows a strong evidence of inertia in fund choices. You can see within the non-coordinated investor, with these first two groups we're looking at, which is the inactive investor, they had 39% made a no change and 30.2% decided to stay within the default fund that they were given. Only 1% decided to make a change to the fund, 9.2% made 2 to 5 changes, 4.1% made between 6 and 20 changes, and 1.2% made 21 to 50 changes. So then if you go over looking at coordinated investors, so those investors who do have financial advisors within the sample size, the number of trades greatly increases. You can see about 17.4% made at least 2 to 5 changes, and then 47.3% making 6 to 20 changes. That's a great change from the 4.1% we only saw from the non-coordinated investors. So this just shows that non-coordinated investors involves 50% of the old portfolio after reallocation, and 40% of fund changes for non-coordinated investors are allocated into the same asset classes. After further analysis, that's what they realized. So with non-coordinated investors, to investigate the relationship between activity and performance for non-coordinated investors, they wanted to sort them based on the number of fund changes that they made in the year prior to return each measurement. So they decided to form 3 different calendar time portfolios by equally weighting individual portfolios in each activity category. And the activity categories are broken down between inactive, which are those who made no changes, active and made at least 1, and highly active, which are in the top decile category. So this table, it goes to show the strong relationship between the past trading activity and future trading activity. Example of this is investors who make no changes in the sorting period, make an average of 0.5% changes per year in the measurement period, where highly active investors make an average of 8.17% per year in the sorting period and 7.15% in the measurement period. The correlation between the two is 0.64, which is significant at the 1% level. The investors, they are slightly, the investors in the premium pension system, they have major exposure to the Swedish and international markets. So that can expose them to a certain level of risk, seeing that they are so heavily invested in a certain area. They relied on traditional based approach to measure investment performance. And the two factors used to evaluate risk-adjusted performance were the hybrid pharma French model that includes excess returns from Swedish and world equity market, minus Swedish and world value HML and size factors, and a factor capturing excess return of Swedish bond market over the risk-free rate. And this also extends the previous model by adding separate Swedish and world momentum factors. This slide just goes to show that investor activity and what the performance is for the different investor levels. Panel A shows the average returns and alphas obtained by these three groups. The average return of the portfolios of investors who made no changes is 3.82%. The active investors who made at least one change is 6.86%. And the highly active investors who made a lot of changes was 12.57%. The t-test between the least and most active categories shows that these results are not economically, but also statistically significant. Then moving on to panel B, this presents the performance that investors would have obtained if they had not made any changes to the portfolio. So they constructed this by discarding all active fund changes made. The results went to show that that this leads to poor performance. Example of this is in the FFCH alpha of 2.09% for active investors, and the alpha decreases to negative 0.61% when no fund changes are kept. The drop in fund changes is more drastic when looking at individuals from a highly active category. Like, as you can see, this goes from 7.56% to 0.30% per year. So even when excluding all active fund changes, the active investor would still have outperformed the inactive investor by 0.24% per year. And this shows that investors in this category simply just make better investment choices to begin with the funds. They're putting their money in better asset classes, and they're deciding when to just execute on those trades as well. So this table goes on to show the anatomy of active investors, active and inactive investors portfolios. They explore in detail the portfolios of these two types of investors. This table shows the different types and where they allocate their money to. The highly active investor, you can see that they're invested heavily in emerging markets. They're invested heavily in emerging markets with 39.8% allocated towards there, and also within fixed income with about 24% total allocated there as well. They also hold a larger number of funds at any point in time and invest in funds that are more specialized and charge higher fees as well. And then you see moving to active investors, they're also a little bit heavily invested in emerging markets, but they're also emerging equity markets, my bad, I should have specified on that. But they also are almost equally as invested in Sweden equity markets as well. They're not as heavily invested in fixed income. And then moving on to inactive investors, they are heavily invested within their Sweden market. And they're also still also heavily invested in the default fund as well. So that just shows they don't have any control of their portfolio. So that analysis, the performance differences can be explained by their tendency to invest in different asset classes. To test this theory, the authors, they performed a return decomposition analysis. And the formula for this just looks like this. Total individual returns equals average fund selection plus fund selection timing plus asset class timing plus average asset class. So that's just a formula they use to be able to decide that the performance differences are just because they invest in different asset classes. This table represents the return decomposition analysis for all different investors in groups separately. As all of the tables in the past, it was broken down between all investors, inactive, and highly active. I'll go more into depth on the analysis in this next slide. The results from this table suggest that the difference in the portfolio in performance between the investors isn't a result of different asset classes or geographic regions. So that sort of goes against what that past table just showed us. This is consistent with results from factor models that use regional equity and fixed income benchmarks as factors. This explains that emerging markets, fixed income, or any other asset classes aren't the main reason for the dominance in portfolio performance. Table A shows that superior performance comes from asset class and timing, asset class timing and fund timing. Highly active investors stands at highly active investors asset class timing stands at 4.77%, and this is the largest and only significant component to their return decomposition analysis. Inactive investors ACT is only at 0.04% per year. And table B shows the risk adjusted using the FSCH model changes the magnitude, but not significantly. So timing is still the largest and highly statistically significant factor. So this shows that highly active investors not only choose good investments, but they also time their choices for the superior returns. So since this shows the importance of timing, the next analysis will look at the time portfolio of the contribution of portfolio changes to the observed results. So this first column, this first column on this table shows the average returns of the specific periods and for which investors. For all investors, the new portfolios outperform the old ones over all the time periods. In most cases, they do it significantly. For highly active investors, the new portfolio exceeds the old one by an annualized 4.67% in the week following the change and 3.74% in the month following. This table shows the majority of benefits from the portfolio changes happens in the month following the change. After that, the outperformance weakens a little bit. This table also goes to help explain more why highly active investors perform so well outside of choosing assets well. They also hold them during the periods where these assets are performing the best. So you can see this in tab B, where it breaks down the average holding period for the different asset class investors, where highly active investors hold their trades for about 55 days, where, sorry, this Zoom tab is in the way of my slide, but I know that for inactive and active investors, it's almost double that amount. So that's just very interesting to see. So then moving on to this table, it shows, or it just touches on this theory of performance chasing. Panel A shows that an average percent of portfolio management invested in funds, which on the day of portfolio was changed, the funds are in the top tier of past performance. So this just shows that when they're making these changes in their portfolio, they're making the changes into top performing funds, essentially. So this table just goes to show that investors are disproportionately choosing top tier funds when making changes. Highly active investors average 51.4% of their portfolio invested in these top tier funds over a 6-month period, and active investors only are in 42.6 of those top tier funds, and for inactive is only 26.5% in those top tier funds. This table shows that all investors might choose funds that perform well in the past. Only highly active investors consistently keep a high portion of recent good past performance in their portfolio. The difference between the highly active and inactive investors is made even more apparent when you consider the entire time period instead of the days after the change was made. Highly active investors, they were had 47.7% of these top tier funds in their portfolio for 6 months of their best performing months, where inactive investors only had 4.3% of those same funds in their portfolio. So this table, it just goes to touch on the prior performance-based return decomposition analysis. This table studies if investors benefit from investing in funds with good recent past performance. They break down the performance into average performance by chasing returns and excess performance. This table shows that by investing in funds in the same past performance decile as highly active investors, they would attain an annual return of 7.58%. Doing the same with an inactive investor would yield you 3.61% annually. Essentially, this table suggests that some of the active investors' outperformance can be credited to their tendency to pursue strategies that benefit from the short-term persistence. Are active investors different? From the data they initially gathered, led them to believe that men tend to be more active investors than women, and there's also a positive relationship between activity and income. As I touched on earlier in the presentation, some of the data that they gathered, they wanted to see the different type of investors and how their performance was, how their performance was able to correlate to their differences. So this table is able to show the results of good pooled regressions of non-coordinated individuals' daily excess returns on factors, a measure of the number of fund changes by each investor, and other individual characteristics. Active investors has a FFCH alpha higher by 2.79% than the inactive investor. Highly active has a FFCH of 8.27%, and the performance difference between active and inactive investors are statistically significant. Adding in age, gender, and income doesn't affect the shape of relationship between activity and performance. So this means that the demographics do not explain superior performance between the investors. This table goes into depth on the coordinated investor performance. Coordinated investors receive recommendations from financial advisors who help manage their portfolios. To study their performance, they created a portfolio that includes all coordinated investors in their sample size. The portfolio has an average return of 3.78%, which is similar to the performance of inactive non-coordinated investors actually, and theirs being 3.68%. So I found that very interesting. They looked more specific at the coordinated period, which is from the start of the first multiple changes to 3 months after the last multiple change. And this portfolio average return of 5.2% per year, so slightly better than what you saw before. Then financial advisors, they also charge a fee for their advice that varies between 1% and 2% of the amount of assets under management. So this table goes to show results of what your return would be with the advisor fee subtracted out already. The overall table shows that individuals who use financial advisors do not perform better than those who manage their portfolios themselves, or even those who are assigned in the default fund. I found this very interesting, as a matter of fact. I just thought that with the resources and the experience that financial advisors have, that they'd be able to use or generate better returns than the typical or average individual investors. So the fact that they perform very close to each other, and even worse when you factor in their fees, that's shocking to me. I hope that I can produce a little bit better returns than that for my clients when I have that opportunity. But that was just crazy to me. And then in this slide, I just want to touch on the impact of flows on fund performance. Mutual funds are required to pay a pro-rated share of the net asset value of the fund to each redeeming investor. So because of this, investors who redeem mutual fund shares or make trades, they will impose externalities on the investors who don't. These externalities come from costs such as brokerage fees, bid-ask spreads, and price impact of trading, all of which can impact fund performance. Excuse me. The funds on this table is a coefficient of the flow measures. For example, in section 2, the outflow variable assumes a value of 1 if outflows are 10 times larger than the average outflow of the fund over the time series. Such extreme flows happen in 1.2% of these observations. To explore long-term impact of these flows, they estimate a 2-equation variance system. In all the specifications, the coefficients for outflows are strongly significantly. Mutual fund would have to liquidate its assets to be able to keep up with all these outflows that are constantly performing if they don't have any inflows to be able to match that. So with inflows, they did not have any noticeable impact on returns because mutual funds with a large inflow, they're able to allocate their money in ways to minimize the price impacts of trades. It also allows them to take positions in certain investments so they can mitigate their cash drag as well. So in conclusion, is inactivity a problem for investors or is activity beneficial to them? While some investors benefit from their constant activity, the whole fund flows generated by this activity negatively affects mutual fund net asset value for all investors. So while like the highly active and top tier investors, they're able to benefit from always being active, those constant fees and prices that the fund has to accrue on their behalf, and as a whole, it can affect all the investors in the pension system as well. So they also learned that active investors earn significantly more than inactive investors. This is not because the active investors take on more risk. This is because these investors successfully time their investments and when they're going to be in those investments as well. They also invest in recent funds or companies that have won or performed very well in the past. So I found this interesting because I always heard that like timing the market or time in the market is better than timing the market. But I guess timing the market does have a very significant impact on how you can perform in a portfolio. So that was very interesting to see. And then lastly, high activity of a minority of investments is a burden for the whole pension system. So this sort of follows into the first point. And there's just several costs that are associated with the fund changes that highly active investors can put onto the pension system. So that's interesting because that's something I never even considered or thought before I read this article. So just my own personal thoughts, reading this article, looking at all this data that they gathered, which I found very interesting. I really enjoyed it. I'd say in my own personal investment strategy, I've always been a little bit more passive or inactive. I make changes maybe to my portfolio, maybe 3 to 5 times a year outside of like buying trades. So just seeing the difference that actively timing the trades and timing when the right time to be with the best performing companies, how that can affect the portfolio. I'm really glad I was able to see this and glad that I was able to get a chance to read this article. So thank you for this opportunity and giving me the chance to read it. And I really enjoyed taking this class this semester. I look forward to taking seminar on finance with you next semester, Dr. Washington. See you then.